The U.S. Treasury's own data shows more than $1 trillion in interest already paid by July 2025, a figure that dwarfs what Washington spends on healthcare, and by year's end that tab is projected to surpass $1.2 trillion. It is the largest interest burden in American history, and it has arrived years ahead of schedule. Officials at the Treasury Department confirmed the milestone in their July statement, noting that interest payments are now the second largest single item in the federal budget. No gradual slope, just a cliff. Debt watchers point out how quickly the slope has steepened. In January 2024, the national debt crossed $34 trillion. By July, it was $35 trillion. By November, $36 trillion. And now, less than a year later, $37 trillion. The Peter G. Peterson Foundation says that the U.S. is adding $1 trillion in debt roughly every 5 months, which is twice as fast as the average pace of the last 25 years. The pandemic accelerated borrowing, but the surge hasn't slowed. Instead, it hardened into normal practice. Inside Congress, the fiscal watchdogs warn the problem is compounding in ways few voters feel day to day until rates shift. Michael Peterson of the Peterson Foundation says higher borrowing adds cost for everyone and reduces private sector investment. The Government Accountability Office lists the ripple effects. Higher mortgage rates, pricier car loans, weaker business investment, slower wage growth. Every household carries part of the load, even if they never see the line item. Yet, even as the debt accelerates, lawmakers have added to it. The Republican tax cut and spending package signed by President Trump earlier this year will add another $4.1 trillion over the next decade, according to the Congressional Budget Office. The CBO's July projections now see the gross debt climbing to 116% of GDP by 2029, which is, nearly double the post-war average. And longer term, the CBO warns, the trajectory reaches 156% by 2055 if current law continues. What was once described as an emergency has become baseline planning. The cost of interest is the new pivot. Back in 2014, net interest on the debt was about $231 billion. By 2024, it had tripled to nearly $800 billion. This year, it has blown past the trillion mark. By 2035, the CBO projects annual net interest will reach $1.8 trillion, which is more than America spends on Medicare, Medicaid, or defense. Interest, a payment for past obligations, is swallowing tomorrow's choices. Bond markets are no longer calm bystanders. The 10-year Treasury yield, the benchmark for mortgages and corporate loans, has hovered above 4% for 3 consecutive years, levels unseen since before the 2008 crisis. At the August auction of 30-year bonds, demand was the weakest in nearly 2 years, according to Reuters, with yields spiking to 4.82%. Investors demanded more compensation to hold U.S. debt, suggesting confidence in Washington's fiscal path is, thinning. The contradiction arrives where markets and rating agencies split. Standard & Poor's still rates the United States AA+, citing tariff revenue gains and a resilient economy, pointing to nearly $28 billion in monthly tariff collections as fiscal support. But Moody's has downgraded, arguing that interest costs now outpace defense and that reliance on tariffs is insufficient to offset entitlement growth and structural deficits. The story fractures. One agency finds resilience, another flashes alarm. Investors are left in between, watching yields rise regardless. That raises a new question. If tariffs temporarily buoy revenue while interest erodes the core, what breaks first? The marketplace, fiscal discipline, or global confidence? It is a puzzle that neither Congress nor the Fed has yet solved. The idea of fiscal dominance now circulates in research notes. Analysts at the Financial Times describe it as the moment when fiscal needs dictate monetary policy. Trump has urged the Federal Reserve to cut rates explicitly to lower debt service costs, even as inflation risks linger. Ray Dalio calls this the debt death spiral, where the central bank loses independence under the weight of government borrowing. For bondholders, that prospect is chilling rate cuts might ease interest expense, but they would risk reigniting inflation. The Congressional Budget Office estimates that under current trends, net interest will consume 22% of federal revenues by 2035, up from 18% today. That would mean nearly a quarter of every tax dollar is sent not to infrastructure, schools, or healthcare, but to creditors. In raw numbers, it equates to roughly $14 trillion in cumulative interest payments over the next decade. This fiscal backdrop explains Trump's urgency on Russia. Reuters reports that he is pressed for direct talks with Vladimir Putin, dropping ceasefire preconditions and suggesting Ukraine cede Crimea in exchange for a broader peace settlement. His officials argue that peace would reopen Russian commodity flows, ease global energy and metal prices, and relieve pressure on United States supply chains. Ending the war isn't framed as moral resolution, but as economic necessity. But, allies are wary. European leaders, according to Politico, believe Putin is using Trump's talks as diplomatic theater. They are insisting on a ceasefire before any recognition of territorial concessions. Ukraine, meanwhile, resists trading land for security guarantees, saying the cost would be too high. Trump sees urgency. Europe sees risk. Kiev sees betrayal. Back in Washington, the United States still imports Russian nuclear fuels, precious metals, and fertilizers despite sanctions. And bilateral trade actually rose 20% after Trump took office, Putin claimed in August. Trump has not placed Russian goods on his tariff lists. The West officially sanctions Moscow, but American markets still draw from Russian commodities. The fiscal desperation intersects with geopolitical necessity. The Sanctioning Russia Act, introduced in Congress, proposes 500% tariffs on buyers of Russian energy if peace talks collapse. It signals to markets that Washington's economic war will escalate if diplomacy fails. Yet, simultaneously, the Treasury quietly adjusted some sanctions to allow limited financial flows to facilitate talks. Carrots and sticks, laid out side by side. Russia itself is straining. Bloomberg reports its war economy is weighed down by higher taxes, surging defense costs, and declining oil revenues. Its gross domestic product growth has slowed, though it's still outpacing parts of Europe. The irony is layered. The United States pleads for relief from interest, Russia bleeds from war costs, and China collects discounted commodities from Moscow. Each power carries fiscal wounds, but in different directions. Meanwhile, manufacturing data in the United States reflects the bind. The ISM index shows 4 straight months of contraction, with new orders down for a 5th month and prices paid hitting their second highest level since 2022. Employment in the sector has fallen for nearly a year straight. Stagflation looms. Slowing growth, rising costs, shrinking margins. Tariffs protect industries from imports, but subsidies keep them afloat, swelling deficits further. The debt is now a geopolitical actor in its own right. Foreign holders own about $8.5 trillion in treasuries, less than a quarter of the total. The rest is held domestically, meaning rising yields directly hit United States investors, pension funds, and banks. The Federal Reserve can't expand its holdings without triggering accusations of quantitative easing. Private investors will demand higher yields to absorb the new issuance. Each auction is now a stress test. In July, the deficit hit $291 billion, which was a 20% increase from the prior year, even though tariffs brought in a record $21 billion that month. So, revenue rises, but spending rises even faster. The Peterson Foundation calls it a damaging cycle of more borrowing, more interest costs, and even more borrowing. And honestly, the cycle is no longer hypothetical. It is the budget. Diplomatic theater overlays fiscal desperation. Trump says ending the war will save America from more wasted billions in military aid, while opening supply routes for critical minerals. Ukraine's east holds rare earth deposits, much of them now under Russian control. In Trump's vision, securing access to those minerals through Moscow could underpin U.S. supply chains without massive new investment. But, the contradiction is sharp, relying on Russia while calling China America's adversary. Supply security through dependence, not independence. Europe sees it differently. Leaders like Germany's Olaf Scholz warn that conceding land will embolden Moscow and weaken Western credibility. Britain's Keir Starmer met with Volodymyr Zelensky in August to reaffirm NATO solidarity. To them, Trump's peace is capitulation dressed as pragmatism. Yet, markets may not care. Bond investors respond to balance sheets, not borders. The United States, once the financial anchor of the world, is now paying more in interest than it spends defending itself. Its president is seeking peace not primarily to end a war, but to buy breathing room in the bond market. Russia, sanctioned and isolated, still sells enough commodities to keep China stocked. Europe, unified in principle, hesitates in practice. And investors from Tokyo to Frankfurt are pricing treasuries higher, testing how long the empire of debt can hold. No grand summary closes it. Just the recognition that America's negotiations with Moscow may be less about Ukraine's borders than about Washington's ledgers. The battlefield is fiscal, the weapon is interest, and the peace offering is less about ending war than stalling collapse. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.